Sometimes a company decides that it no longer needs a fixed asset before the end of its useful life. For example, a company might have a work truck that they've been using that's part of property, plant, and equipment. They've been depreciating the truck over time, and they're expecting it to last 10 years, but then in year 6, year 7, year 8, sometime before the end of year 10, they decide, you know what, we don't need this work truck anymore. Maybe the truck broke down, they don't feel like fixing it, and so they are going to get rid of or retire that fixed asset. So we're going to treat this similar to a disposal of an asset. The only difference is that we're not going to be receiving any cash. As I said, they're not selling the truck. They're just going to take it to a junkyard and say, you know what, we're done with this fixed asset. So the question is, how do we account for that? So let's do an example. Let's say we've got a company called Cardboard Surfboards, and they decide that they want to get rid of some manufacturing equipment. It's no longer useful to them. Maybe they said, you know what, people actually don't like cardboard surfboards as much as we thought they would, so we don't need this manufacturing equipment and to make them anymore. So let's say that the equipment had an original cost of $100,000. That's back when they originally purchased the manufacturing equipment. Okay, they would have debited the property, plant, and equipment account, increased it by $100,000. But they have taken depreciation on that manufacturing equipment since that time, and they have accumulated depreciation of $85,000. So they bought the asset for $100,000. They have taken $85,000 of depreciation, so its net book value is $15,000. But they're not selling the equipment. They're just going to get rid of it. They're just going to take it to a landfill or something like that. So what are they going to do? So we're going to have to credit the property, plant, and equipment account for $100,000. That's to signify that we no longer have this equipment on the balance sheet. Okay, it originally cost $100,000, so we had debited the equipment account back in the day, and now we're going to credit that equipment account. We also need to get rid of the $85,000 of accumulated depreciation, so we are going to debit that. So we're going to debit the accumulated depreciation for $85,000. But notice, the total debits do not equal the total credits. So we've got a problem here. We're going to need to have a debit of $15,000. And what is that going to be? That's going to be a loss on the retirement of this asset. So this is going to reduce the company's net income on its income statement. Now note, because we're never going to receive cash on a retirement, we can never recognize a gain on a retirement. Okay, so in this example, basically we have the net book value of $15,000 of this asset. We're just saying, you know what, we're getting rid of it. So we're just going to book a loss, debit the loss, get the accumulated depreciation off the books, and credit the property, plant, and equipment account. And this asset is history.